Hello there. Thank you for coming to our webinar today. My name is Marcia Butler. I am the webinar director here at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and could not be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we're thrilled to bring you today's educational presentation, and we're going to tell you a couple housekeeping notes. You are on mute, but we do encourage you to ask questions using the chat box. We will have a question and answer portion of the presentation at the end of the prepared slides. The presenter will answer those queries as possible, and we are going to have a large crowd here. I've already seen the room fill up. So if we're not able to get to your question, go ahead and leave your contact information in the chat as well. And we will make sure someone reaches out to you after today's event if we're not able to get to that. So we want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. And again, we will be addressing those questions at the end of the prepared slides. Well, I'd love to introduce you to our presenter today. Eric Lardner has over 30 years of experience working in financial markets, providing market analysis and financial strategies. Eric has specialized in several aspects of comprehensive financial planning, including investments, income strategies, insurance, asset preservation, and estate planning. Eric founded Abundant Wealth Management to focus on managing funds to increase total return and income, reduce risk, and help protect assets for his clients. He has over 10 years experience working directly with individual advisory clients and is a Series 65 licensed investment advisor representative and fiduciary with Sound Income Strategies, LLC, an SEC registered investment advisory firm. Eric has been an exclusive franchise owner in Dallas, Texas for Retirement Income Source since 2020. He graduated from St. Mark's in Dallas, Texas, and has a BA from Tulane University and a master's in international management with a specialization in finance from the Thunderbird School of Global Management in Phoenix, Arizona. And Eric, I know we've prepared a lot for this presentation today, and I'm really excited to have you here to help our attendees learn a little bit more about the complicated world of Social Security. And I'm going to go ahead and turn the time over to you.
Okay. Thanks very much, Marcia. Right at the top, I want to thank everybody for being here. I know you're all busy, so thank you for joining us. There's a lot of material to cover. There's over 20,000 pages in the Social Security manual, and that doesn't include the addendums. So as Marcia mentioned, we're going to save some time at the end to answer everybody's questions. I highly encourage you, if you have a pen and a piece of paper, to perhaps write some things down, take some notes, and turn your cell phone off so there's no distractions. So we're going to cover a lot of material, so let's get started. So savvy Social Security, what people need to know to help maximize their Social Security benefits. What most people don't know is that the difference between the maximum strategy and the second, third, or fourth best strategy to claim Social Security benefits can mean in excess of $100,000 in lost Social Security benefits over the course of your lifetime. If you're married, for couples that qualify for Social Security benefits, those numbers can be amplified up to 2 times that amount. So it's real important to understand all the things that you need to consider when declaring your Social Security benefits. So to that end, I want to share a personal story. That's a picture of me and my mother. My father, when he was 62, which is the earliest that you can claim Social Security benefits, without consulting anyone, he decided that he was going to go ahead and claim his Social Security benefits. He did not need to do that at the time. Unfortunately, a few years later, he and my mother were traveling overseas, and I got a phone call from her, and she said, "Your dad laid down for a nap and didn't wake up." So that obviously brought everything to the forefront in my world, insofar as her finances were concerned. And what we realized is that over the course of the intervening years, and if she lives till 90, which her doctor thinks she will, she's got a very good chance of doing that, she's going to lose over $100,000 in Social Security benefits because my father decided to declare too early when he could have waited. So that's a real life example of how it can really impact your benefits over the course of time, and why it's so important to understand the rules which we're going to go through here today. So we're going to answer the 5 questions about Social Security that most people want answered. Will Social Security be there for me? How much can you expect to receive? When should you apply? What will your maximum benefits be? How can you help maximize those benefits? And last but not least, will Social Security be enough to live on in retirement? Now, if you're smart enough to be here on this webinar today, you probably already recognize that Social Security benefits are not going to be enough to live on in retirement. Statistically, the average is about 35 to 40% of people's retirement income comes from Social Security. So let's get into those details a little bit right now. So a few important terms to know as I go through this presentation. You might want to jot down these acronyms. COLA, or cost of living adjustment. I'm sure most of you are familiar with that. FRA stands for full retirement age, which sometimes is referred to as the normal retirement age. PIA is the primary insurance amount. FRA and PIA are correlated because the PIA is the amount of Social Security benefits that you will receive at full retirement age. And we're going to go through those details here shortly. DRC stands for delayed retirement credit. We're going to go through those in detail here shortly as well. And then early retirement reduction, or ERR, we're going to go through what happens if you declare early, which I've already alluded to earlier with what happened to my mother and her benefits. All right, so Social Security offers benefits that you cannot outlive. Said another way, that's basically a guaranteed lifetime income stream from the federal government. In this example, if you assume a $2,000 a month benefit today, over 10 years, that's going to be almost $300,000, 20 years over $600,000, 30 years over $1 million. So the thing that I like to point out on this slide is that if you're going to be on Social Security benefits just for yourself, and you're on benefits for 30 years or more, that can be over $1 million in lifetime income, which is, sometimes Social Security has oftentimes been the punchline of a joke, but $1 million in retirement income is not a laughing matter. So particularly for couples out there, that number can be 2 times that amount. So again, it's very, very important to understand all the nuances of when to claim your benefit and how to maximize those benefits. So you may want to know how those benefits are calculated. At age 62, they're going to take all the years that you've earned income that has qualified for Social Security benefits. They're going to take the highest 35 years of your earnings and calculate what's called an average indexed monthly earnings, or AIME. They're going to take that AIME and divide it by 3 bend points, and that's going to determine your primary insurance amount, which is, again, the amount that you'll receive at full retirement age. And those benefits are increased each year, you see at the bottom here, by the cost of living adjustments. So those are how your benefits are calculated. The OASDI trust fund, this gets to the question of will your Social Security benefits be there for you? The Old Age Security Disability Insurance Fund, the balance at the end of 2020 was just over 2.9 billion. You can see the balance at the end of 2021 is a little over 2.8 trillion. So the fund is starting to be depleted. In 2021, the fund was depleted by 56 billion. So there's more people claiming benefits that are paying into the trust fund. So you can see the math on how the fund is starting to be depleted. So what are the long-term projections on where we might wind up? It's been in the news quite a bit. I'm sure you've heard some of the negotiations back and forth, but looking down the road into the future, what may happen to benefits if they don't modify the system to make sure that the fund doesn't get depleted. They estimate that by 2035, benefits may have to be reduced here by about 21%. And this is an estimate. I don't want to bog you guys down in the chart here. It's a little bit too much inside baseball, but the long and the short of it is by 2035, they're going to have to do something to modify how benefits are claimed and how they're calculated in order to make the fund solvent. The good news for those of you watching, if you've claimed in advance of the time where they have to make those changes, you should be grandfathered in. So once you're on benefits, it's highly unlikely that they're going to reduce your benefit once you've claimed your Social Security. So what might they do to change the system in order to keep the fund replenished? They may increase the maximum earnings subject to Social Security tax. That's this first item here. Right now, the limit in 2023 is $160,200 on earnings that are taxed for Social Security. That goes up a little bit every year. They could raise the normal retirement age. They've already done that once. We're going to go through this in more detail later. Right now, the range is between 66 to 67 for your full retirement age. They could lower the benefits for future retirees, or they could reduce the cost of living adjustments. For 2023, the adjustment was 8.7% here, which is a reflection of what inflation has been doing the last 12 to 18 months. The historical average is about 2.7% for cost of living adjustments. All right, factors that you need to consider. Obviously, your health status and life expectancy are correlated. You're going to want to factor in your life expectancy, whether you've got, I've got a client whose mother just turned 101, so we're planning for her to have a long life. For you couples out there, there's about a 50% chance that one or both of you, if you've already reached the age of 65, that one or both of you is going to live till 90. We have to consider your income needs, and that's going to involve more than just your Social Security benefits. We're going to have to look at all your sources of income in retirement, whether it's a pension, retirement accounts, or other sources of income, and we're going to talk a bit more about that later. Whether or not you continue to work. So some people continue to work, beyond 65, or some people retire before 65. It just kind of depends. Everybody's situation is different. We're going to go through some of the impacts that are felt if you go on benefits for Social Security and you're still working. And then survivor needs. So this is real important for you couples out there. I talked about the example of my mother at the top. And we're going to go through some of the strategies for couples in greater detail here shortly. All right, so let's talk about full retirement age. Exactly when is that? So if you were born over here in this left column between 1943 and 1954, your full retirement age is going to be 66. And you can see that increases 2 months for every respective year, all the way up until 1960 or later. If you were born in 1960 or later, your full retirement age is 67. So what if you apply early for benefits? You will receive a discount on your primary insurance amount. In other words, you're going to get a haircut, okay? So if you claim at 62 and your full retirement age is 67, you can see here, you're going to get a 30% haircut on your Social Security benefits. And again, this comes into play depending on your, this may be a long-term impact for those couples out there. You want to make sure you're maximizing your benefits. You can see the respective increase for each year that you wait, all the way up until age 67, if that's your full retirement age, where you would get 100% of your primary insurance amount, or PIA. So what if you apply after your full retirement age? Well, great news. So raise your hand if any of you are receiving an 8% guarantee on your money right now. Don't know if there's many hands raised out there, but you will get an 8% bonus called delayed retirement credits, or DRCs, which we talked about at the top, for every year you wait beyond your full retirement age. So again, we're going to look at full retirement age of 67. If you declare at 66, that's the discount you're going to get. At 67, you'd get 100%, all the way up to age 70. If you waited that long, you would get a 24% bonus on top of your PIA. If you happen to have a full retirement age of 66 and you wait till 70, you're going to get a 32% bonus. So more good news if you were born a little bit earlier. All right, so there are some estimators out there on your Social Security benefits. You've got these resources at Social Security. You can write down these respective websites. There is software out there that's a little bit more robust, where you can calculate your maximum strategies. And again, just to reiterate what I alluded to at the top, the difference between the maximum strategy and your second, third, or fourth best strategy can oftentimes be $100,000 or more over the course of your lifetime. For couples, that can be 2 times that amount. All right, so let's talk about a real world example, starting with spousal benefits. Spousal benefits are 50% of the primary wage earner's benefit if started at full retirement age. So again, we're using these acronyms again, at full retirement age being FRA. If John's PIA, that is primary insurance amount, is $2,000 and Jane's PIA is $800, if Jane applies for her benefit at her full retirement age, her benefit will be $1,000, or 50% of John's PIA. So because she's claiming a spousal benefit, his benefit's greater, 50% of his is more than her $800 benefit. So she's going to want to claim a spousal benefit rather than relying on her benefit. Just a little fun statistical fact here. If you claim it at 62 rather than waiting till your full retirement age on a spousal benefit, that's a 41% reduction. Okay, rules for spousal benefits. The primary worker must have filed for benefits. The spouse must be at least 62 for a reduced benefit, or full retirement age for a full benefit. There are no delayed retirement credits on spousal benefits after full retirement age. I'm going to reiterate that here shortly. That's a real important point. And then this last point here, there used to be a way to kind of game the system where the higher earning spouse could make a spousal benefit claim on the lower earning spouse, collect those benefits, wait till 70, and then collect their own benefit. But they changed that rule in 2016. So unless you're grandfathered into that, that won't apply. But I always like to mention that because I usually get a question on that. All right, let's talk real quickly about divorced spouse benefits. They're the same as spousal benefits. The marriage must have lasted 10 years or more. The person receiving divorced spouse benefits must remain unmarried. That is if you get remarried, you're not eligible to claim benefits on an ex-spouse. I don't know if anybody remembers how many wives Larry King had, or how many of them he was married to for more than 10 years, but any one of them he was married to for 10 years could have claimed benefits. It would not have affected the benefits for him or any of his other ex-wives. Just kind of a little bit sad on how the system has that kind of waste, but that is available for people that may have been married more than once. If the divorce was more than 2 years ago, the ex-spouse does not have to have filed for their benefits. All right, some additional rules. Like I've already mentioned, go through this quickly. More than one ex-spouse can claim on benefits. They do not affect the other workers. The ex-spouse's benefits or the current spouse. And then they stop upon the remarriage of anyone collecting an ex-spouse benefit. So if you're collecting on an ex-spouse and you get remarried, those benefits will end. All right, so let's spend a little bit more detail on survivor benefits. There's two key factors when you're talking about survivor benefits. The first is the age at which the deceased spouse originally claimed their benefit, which is referred to as the original benefit. If the deceased claimed before their full retirement age, the survivor benefit will be limited to the higher of the deceased spouse's benefit, or 82.5% of their primary insurance amount. So regardless of when, of what the timing is, if it's before full retirement age, there will be a discount on the benefit, which is where my mother's situation came into play. That's why she got that reduction. If the deceased claimed after full retirement age, the survivor benefit will include delayed retirement credits. So DRCs are that 8% bonus that we talked about. So whereas for spousal benefits, DRCs do not apply, so it doesn't pay to wait longer than full retirement age. DRCs do apply for survivor benefits. So this is real important for you married couples out there. The longer that the higher earning spouse can wait to claim their benefit, the better off in many cases that you'll be with the higher survivor benefit. The second key factor is the age at which the survivor claims the survivor benefit. You can claim a survivor benefit as early as age 60, and that's prorated each year up to age 70. If the survivor claims at full retirement age or later, the survivor benefit will be 100% of the original benefit, including delayed retirement credits. So if you're in a situation where your spouse is deceased, you can claim at 60, but you will earn more in survivor benefits the longer you wait as well, even getting the delayed retirement credits waiting beyond your full retirement age. So hopefully everyone understands that. Let me go through an example real quick, because sometimes that can be easier to understand. So if a spouse dies where both are receiving benefits, the widow or widower may switch to the higher benefit. So Joe and Julie are married, both are over full retirement age. Joe's benefit is $2,800 and Julie's benefit is $1,500. Joe passes away. Julie notifies Social Security and her $1,500 benefit is replaced by a $2,800 benefit, which is a survivor benefit basically.
Oh, Eric, it looks like you cut out there.
Joe's benefit. Now,
sorry,
what
Eric.
if the delay? Okay, hang on here.
Why don't you go ahead and cut your video? I think we had gotten a little bit of an audio lapse there.
Okay.
All right, can you go back to the previous one? So after Joe dies, I think it cut out. So can you pick up right
Joe
then?
Dies, so that's taking over the survivor benefit before getting delayed retirement credits. So let's look at a benefit when delayed retirement credits do come into play. So if the same couple, Joe and Julie, Joe's PIA is $2,800. Joe delays claiming to age 70, so he gets that $24% bonus, making his $2,800 benefit $3,472. He passes away, so Julie's survivor benefit becomes $3,472, not the $2,800, because Joe waited for his benefits to maximize his delayed retirement credits. So, and just a note here, if Julie claims before her full retirement age, she will get less. So it does always pay to wait, but again, people's circumstances are different depending on if and when you need the income. All right, so rules for survivor benefits. This is, I'm going to move this to the other side. Couples may have been married, must have been married at least 9 months. This applies for people that may have gotten remarried later in life. They have a second spouse. If their spouse predeceases them, the marriage must have lasted at least 9 months. The survivor must be at least 60 for a reduced benefit. I talked about that in the previous slide, or full retirement age for a full benefit. If the survivor remarries, they're not available for benefits unless that marriage ends. Last but not least, the divorce benefit, same rule applies, available if the marriage lasted at least 10 years. All right. Ways to improve your earnings record. This is the first maximization strategy we're going to talk about. So you want to take a look at your earnings history. Surprise, surprise, Social Security may have made a mistake on your earnings record. So you want to make sure that you go to Social Security and you look at your earnings record, and you can see the website there where you can go online and check your earnings history. You want to make sure it's accurate. You want to make sure there are no missing years. And can you improve it by working longer? So we talked about how they calculate your Social Security benefits. If you're making more money later in life, which most people are, and you want to continue working, that's going to improve your Social Security benefit. Another strategy to consider to maximize your benefit, you want to obviously consider your income needs both now and in the future. We talked about life expectancy and your spouse's life expectancy. And it's the higher earning spouse needs to very seriously consider waiting until age 70 if possible. That mainly has to do with survivor benefits, which over the course of not one life, but two, can really add up to a significant amount in lost benefits. Okay, if you want to keep working, there's something called an annual earnings test. And the way this works is, if you've claimed Social Security benefits before full retirement age, that is at 62, $1 in benefits are going to be withheld for every $2 you earn over 21,240. And that changes every year. It went up a little bit in 2023. The benefits are adjusted at full retirement age. That is, if you stop working at full retirement age, that you will get that money back. They will pay it out to you over the subsequent months. And so you do earn that money back if you're subject to the annual earnings test. If you continue working and you're at full retirement age, the earnings test limit for people that have reached full retirement age in 2023 is 56,520. So you're able to earn more without being subject to the clawback, so to speak. And that clawback is going to be $1 for every benefit over $3 earned over $56,520 in 2023. So it does pay. You can increase your benefits by working longer. Just be aware of the earnings test depending on where you are relative to your full retirement age. All right, let's talk about taxation here for a minute. So Social Security, they tax your benefits differently than the IRS taxes your income. So go figure. They tax it based on what's called provisional income, which is here at the bottom, which is your adjusted gross income plus 1/2 of your Social Security benefit plus tax exempt interest. So tax exempt interest is any municipal bond interest that you may have if you're invested in municipal bonds. That's considered tax-free income on your federal taxes, but insofar as taxation on your Social Security benefits, those are subject to tax. The provisional income, if you're married filing jointly, I'll look at this center column here. If you're making over $44,000, up to 85% of your Social Security benefits are subject to tax. So I want to make sure that everybody's clear on that. That is not an 85% tax rate. That is up to 85% of your Social Security benefits are subject to tax. You can see the respective limits depending on your filing status. The limits aren't very high, so we want to look at all your sources of income to kind of adjust for taxes to make sure not only are you being efficient insofar as when you claim your Social Security benefits, but are you being efficient from a tax perspective? Which leads me to my next slide, which is considering Social Security benefits in the context of pensions, IRAs, 401ks, 403bs, retirement plans. Whether you like it or not, the government's going to force you to take money out of your retirement plan, which is required minimum distributions or RMDs at age 73. You may have separate investment portfolios that are not subject to RMDs. You may also consider working while you've claimed Social Security benefits, whether it's before your full retirement age or after. So all of these are different sources of income that we have to consider when looking at your Social Security benefits insofar as when to claim and maximize your strategy. So there's tax considerations, there's income need considerations, income want considerations. So we have to look at everything in the big picture. We can't just look at your Social Security benefits in a silo and say, this is your maximum strategy without looking at your other sources of retirement income. Now, this comes into play. There's really three cycles of investing, or stages, I should say. The accumulation stage is, those are your go-go years. That's when you're typically earning the most money. The transition stage begins typically within 10 years of retirement. Traditionally that would be around the age 55 if you're thinking about retirement at 65. So the transition stage is when you want to start thinking about how you're invested. And then the distribution stage is 180-degree turn from the accumulation stage. So the accumulation stage, you're trying to accumulate as much as you can. You're transitioning over a number of years till you finally get to retirement. You're in the distribution stage. Then the question becomes, how much income are you generating in retirement to maintain your lifestyle? That becomes the goal. Income and protection of the assets that you've accumulated become the goals in retirement. Which leads us to a key transition that needs to be considered when you're approaching or in retirement. And the foundation of that is a formula called TR equals I plus G, which stands for total return equals income plus growth. The income comes from dividends and interest. The growth is capital growth or capital appreciation, which we know from what the market did last year can also be a loss. So that brings into question, are you invested properly for your phase of life? Will you have to sell shares to generate income to maintain your lifestyle or meet your income needs? That can be one of the worst things that we see people do in retirement, is having to sell shares from their retirement savings in order to generate income to maintain their lifestyle. We want to try to avoid that as much as possible. And then investing for consistent dividends and interest. So it represents the I portion of the formula, the two components being income and growth. So there's been a traditional rule on Wall Street called the 4% cash flow rule. What it basically says is that you can rely safely on growth on your retirement savings up to 4% a year to withdraw as income in retirement and not have to worry about outliving your retirement savings. Which begs the question, what if you'd retired in 2000 and you had been relying on growth to supplement your income in retirement. So the average annual return in the 21st century from 2000 to 2000 to the end of 2022 is 6.49%. So using the 4% rule, most people think, yeah, I'd be fine if I was using the 4% rule. Well, let's look at a little market history. The period of time from 2000 to 2012, we saw some of the biggest declines in the market over a condensed period of time that we've seen in the last 20 years for sure. But if you're relying on the 4% rule and you're withdrawing 4% on $1 million, I know everybody doesn't have $1 million in retirement savings, but we use that number just to kind of keep the math simple. 4% on $1 million is $40,000. If you're withdrawing that each year to supplement your retirement income in a market where you've got down years and you're withdrawing funds, that is, you're selling shares to generate income in retirement, it's depleting your retirement savings. It's depleting your principal. After 3 years, if you'd retired in 2000, you're down to about half. At that point, you might be thinking about going back to work, perhaps selling your house, things like that you really don't want to have to think about in retirement, right? So by the time we got to 2008 in the global financial crisis, we had another major downturn. If you're selling shares to generate income, now you're down to about 40% of the original $1 million that you started with. For most people, that's going to be a stage of panic and fear. So those are situations that we want to avoid in retirement, which is depleting your principal by relying on growth to supplement your retirement income. And again, this is in the context of looking also at your Social Security benefits and making sure that you're structured the right way and when you want to declare your Social Security benefits. So let's look at a graphic illustration of that period of time. And what it's illustrating is what we call sequence of return risk. So what that means is over the course of time, the market will eventually go up, but over certain periods of time, the market doesn't always go up. So looking at that period of time from 2000 to 2013, we had the dot-com crash. I'm sure everybody remembers that. Then the market rebounded and it got back to even just before the financial crisis. And we had the global financial crisis and we had that another major drop. It took until 2013 until the market finally got back to even. That's 13 years of zero growth, which illustrates the problem of relying on growth to supplement your income in retirement. If in a down market, you're going to be depleting your principal, and we want to avoid that kind of circumstance. So I know what some of you may be thinking, Eric, you probably cherry picked 13 years when we had that sequence of return risk, and I think I'm okay. Well, let's look at a longer period of history and see what the markets have done over a longer period of time. So if you believe that history repeats itself, that's definitely true when it comes to the stock market. Since 1900, we have had several major periods of time with zero growth in the market. You can see this graph here illustrates the Dow Jones from 1900 to 2020. This first zero growth period was from 1900 to 1921. Then we had the Roaring '20s up till the Great Depression. From 1929 until 1954, we had another period of zero growth. Then we had another ramp up until 1966. And then from 1966 until 1982, another period of zero growth. From 82 to 2000, we had the largest increase in the market in history. And then we just went through what happened during the dot-com crash and the great financial crisis. Subsequently, we've had this huge run-up Last year, we had an 18% decline in the market. I'm sure everybody recognized that when they opened up their statements. They saw, whoops, the market went down last year. How do we fix that? So we want to consider investing for income or spending the income from our retirement savings rather than selling shares to manufacture or engineer income. So the simple income method, excuse me, again, looking at the S&P 500 here, the average historical dividend on the S&P 500 is about 1.5%. So using the same $1 million that we saw on the previous slide, if you're just spending the dividend, that's 1.5% of $1 million is $15,000. Now, if you're just spending that, you can see that at the end of that 13-year period of time, the market did come back. So you've got what you started with, but $15,000 isn't a whole lot. We want to do better than that, right? So we protected our chickens by not selling shares through this sequence of return risk period of time, but we didn't really generate a whole lot of income. So let's look at an enhanced portfolio or an enhanced income method. And this is a hypothetical portfolio. Again, the same period of time, 2000 to 2013, into 2012. Now you're not withdrawing 4%, you're spending 4%, which is the enhanced dividends and interest that you can earn on your investments. So rather than having to sell your chickens, you're protecting your chickens and you're eating the eggs that the chickens are producing. It's a metaphor that most people can understand. You want to protect your chickens. So in this example, you've got this enhanced dividend. That's money that you can spend to supplement your income in retirement to meet your income needs and wants and maintain your lifestyle. And you're protecting your chickens, as you can see, by not having to sell shares to generate income. That's the enhanced dividend income method. So there are, looking at the historical returns with an enhanced portfolio focused on income, the period of time from 2000 to 2019, through 2019, if you're just looking at a standard portfolio that most people have, that averaged out to a 5.97% total return over that period of time. With a 4% enhanced dividend portfolio, that increases the total return to just over 11%. So even if you're not in retirement and you don't need the income yet, the power of including dividends and interest in your portfolio, if you don't need the income, you can reinvest the dividends and income, and it really amplifies your total return over a number of years. So I'd like to show that slide to just illustrate that for people. So trying to wrap it up here, metaphorically speaking, the chicken being your principal and the eggs being the income. You don't want to eat your chickens. You want to eat your eggs, or you want to reinvest your eggs. And again, this comes in the context of trying to maximize not just your Social Security benefits, but your other sources of income in retirement, which is going to have an impact on when you decide to claim your benefits so that you can meet your income needs and wants in retirement. And again, just a reminder, that's the formula there. TR equals I plus G, total return equals income plus growth. Now, you may have questions. When should you apply for Social Security? What if you want to keep working? What if you've already applied? How much will your benefit be? How can you coordinate spousal benefits? That's a very important question. What's the best long-term strategy for your situation? Will you have enough income in retirement? What do you do next? So I'm going to conclude at this point and hand it over to Marche for questions. If anybody has any questions, we can spend some time here to go through that.
We got a bunch of questions and we'll try to get to as many of them as we can. And there are quite a few questions about some of the Social Security stuff you went over. So I'll pop over to those screens as the questions dictate here. So here's a question. If one starts getting Social Security benefits at full retirement, but then gets a job that pays more than they ever earned prior to getting benefits, will that benefit amount be readjusted higher? And if so, when will you see that rise?
So they readjust your benefits every year. They're going to recalculate using that AIME calculation that we went through. If you wanted to suspend your benefits, if you've reached full retirement age and suddenly you got a raise at work or something, you can suspend your benefits so that you're not subject to the clawback. And they will also, if you suspend your benefits after full retirement age, they will give you delayed retirement credits. So that may be something else to consider. If you've already reached full retirement age, you're on benefits, and perhaps you want to take a look at the math on suspending your benefits so that you can get delayed retirement credits.
All right.
That answers your question.
Put it in the chat if you have more questions there. What if you started collecting on an ex-spouse's benefit at full retirement age and then at 70 remarry? So do the ex-spouse benefits expire, and can I then claim full retirement Social Security on my own benefits?
So if you're claiming ex-spouse benefits and you remarry, then you're no longer eligible to claim benefits on an ex-spouse. So those benefits will go away. If you do qualify for Social Security benefits on your own merits, you would just simply need to contact Social Security and then find out what your benefit would be if you wanted to go on your own benefit. But you want to think about your current spouse's Social Security benefits also. There may be a strategy there that makes more sense insofar as who the higher earning spouse is, and whether or not you actually want to go on your own benefit, or it may be advisable to wait. You'd have to look at both your benefits and your new spouse's benefits to make that decision.
All right, here's another question. If my spouse is a teacher and gets a pension and never contributed to Social Security, if I pass away, will she be eligible for Social Security spousal benefits? And what percentage will she get if I retired at full retirement age?
So let me make sure I understand the question. If the spouse is a teacher, are they eligible for the spouse's Social Security benefits if they qualify and they were not a teacher? Is that the question?
So they're just explaining a situation where the spouse hasn't contributed to the Social Security system.
Okay, so the spouse would be eligible to claim a spousal benefit based on the spouse's benefit. That would, because teachers aren't going to qualify for Social Security benefit, they have another structure that they get benefits from. You'd be looking at a 50% spousal benefit. It would pay to wait. If you wait longer to declare your benefit, the delayed retirement credits would come into play for your spouse. So you would want to look at perhaps delaying benefit beyond your full retirement age to get those delayed retirement credits since your spouse doesn't qualify.
And then the question also is if when that spouse passes away, the one who had qualified for Social Security, do they get all of that benefit as a survivor or a percentage? How does that work?
The survivor benefit rules would apply in that circumstance. So again, that's why I said if you wait to declare your benefit to maximize the delayed retirement credits, your spouse will get those if you predecease your spouse. So that's an important consideration.
All right. when should a lower earning spouse claim their benefit? And how does that impact the 50% benefit rule when the higher spouse claim or the higher earning spouse claims their benefit?
You would, if your benefit's less than your spouse's benefit, you would just have to determine if a spousal benefit of is more than your own benefit. That is, if 50% of your spouse's benefit is more than your benefit, you would want to claim a spousal benefit, but you have to keep in mind, if you claim on their benefit, they'll be deemed to have claimed their benefit. So you want to be careful there. You don't want to force your spouse to be deemed to have declared their benefit. In that circumstance, you may be better off just declaring your own benefit. But you'd have to look at the numbers to see exactly where things fall.
All right, here's a question about timing. So let's say that you'd like to apply for Social Security right away, and you stopped working, say, the end of last year. But since you worked through the end of last year, you want to capture that additional. So this person is saying they're past full retirement age and they want to capture that 8% bonus amount. So
If they're already
when
in a benefit,
if they're not already, they haven't applied yet. So they're wondering, like, at what point do they need to apply to make sure last year's waiting counts towards their benefit?
so you're going to get delayed after full retirement age. The delayed retirement credits apply up until the age 70. So it doesn't pay to wait past age 70, and you'll get a prorated amount of the 8% for each month that you wait after your full retirement age. So
okay, so it's based on the month.
you'll get a prorated amount of the 8% per year for each month you wait after full retirement age.
All right, thank you for that. I'm looking through these and making sure that I've addressed some of these. Okay. Is your pension considered earnings when it comes to taxation and also on
Yes.
yeah, so that's
So
included.
adjusted gross income is going to look at all your sources of income, right? Whether it's pension income, you may have annuity income, you may have dividends and interest coming off of your retirement savings. All those sources of income count towards the total that you're going to pay for your federal taxes and how they're calculating the taxes on your Social Security benefits. So you'd have to factor in if you have any tax-free income from municipal bonds, that's going to factor into your provisional income. So there's all sorts of things that you have to look at to figure out, okay, what's your best Social Security strategy, but what's your best tax strategy, and what's your best income strategy, looking at all your sources of income in retirement. So that's why I go through all that information, to make sure everybody understands we're not just looking at Social Security. We got to look at pensions. We got to look at retirement account income. We got to look at any annuity income you may have. All your different sources of income are going to have an impact on when exactly you declare for your Social Security benefits.
All right, and then we had a question again about this slide. Can you explain again how Social Security gets reduced if you haven't reached your full retirement age and you're claiming on it but still working?
Right. So everybody always has a question on this. There's always somebody. So if you've claimed your Social Security benefits before your full retirement age, in this top section here, I don't know if they can see my pointer, but $1 in benefits will be withheld for every $2 earned over $21,240 in 2023. So if you make $2, if you make $21,242, they will, and you're on Social Security before full retirement age, they will withhold $1 in your Social Security benefits. And
Oh,
that the same math applies for every $2 over 21,240. That makes sense.
and this is before you've reached full retirement age. Does that happen after you've reached full retirement age?
Right. So if we look at the third bullet point there, once you've reached full retirement age, they adjust the earnings test limit up to the 56,520. So
Okay,
at that point, they're gonna reduce your benefit by $1 for every $3 earned over the 56,520 in 2023. And those numbers change every year.
speaking of what changes every year, does cost of living adjustments change every year?
They do. So this year, the cost of living adjustment was 8.7%. So everybody on Social Security benefits or eligible for Social Security benefits saw their benefit increase by 8.7%. So the cost of living adjustments apply once you turn 62, whether you're on benefits or not.
All right, here's a question about an example we had here. Let me go see if I can get the slide up. All right. So for example, Joe dies before 70 but hasn't claimed his Social Security benefits. Does the spouse get survivor benefits? How does that work if they hadn't claimed?
So if the spouse dies, then you're eligible for a survivor benefit, which is where delayed retirement credits come into play. So that's the importance of waiting when you are married. The higher earning spouse is going to want to wait as long as possible to declare their benefit, because survivor benefits do include delayed retirement credits, which is the 8% bonus you get every year for waiting past your full retirement age.
All right, thanks for that clarification. How do you determine when to file Social Security if both husband and wife are basically earning the same, but they're different ages? What are you looking at on those factors?
It depends on the age discrepancy between the spouses. And again, it's gonna be determined on your individual circumstances. That is, what are your income needs? What are your other sources of income in retirement? And are you able to wait longer and still have your income needs and wants met without having to claim, without both of you having to claim Social Security? So there's a lot of moving parts. You know, there's really no one correct answer to that question. It's going to depend on your individual circumstances, but it would start with looking at your age discrepancy and over time, doing a maximization analysis and seeing where the numbers come out based on when each person were to declare their benefits.
All right, well, that's a good one to end on, because it does kind of speak to the fact here that Social Security is only part of the retirement income planning puzzle. And really, that's kind of where Advice Chaser comes in, is to help people find advisors that can help them with that. Well, that's about all the time we have for questions. If we didn't have a chance to answer your question, go ahead and leave your contact information in the chat. I'll make sure to save that and make sure that gets addressed after the webinar. Here at Advice Chaser, we do a lot of webinars, and we want to thank all of the organizations that have made that possible. We want to thank Eric for being here, and we want to thank our attendees. Look for a link to the replay of this event, and you're welcome to share that replay with friends and family. We will be emailing that in the next day. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Thank you once again to everyone for being here, and we hope to see you at another webinar soon. Goodbye, everyone.